Capital gains tax, or CGT, is the Australian tax you pay on profits from selling assets, such as ETFs, shares, crypto and property, and many other types of investments. Only a few assets are exempt from capital gains tax in Australia, and the biggest exemption is your main residence. Otherwise, most investors who have made a profit have to pay capital gains tax at some point in time. Step 1. Work out what you receive for the asset. This is your capital proceeds. It is what you receive when you sell the asset. For example, if I sold 100 Woolworths shares at $36.40 per share on the 23rd of June 2022, then my capital proceeds would be $3,640. Step 2. Work out your cost for the asset. Your cost base is what it costs you to acquire the asset, plus any other costs you had to acquire it, hold it, and dispose of the asset. So if I bought 50 shares in Woolworths 20 years ago for $12.03 per share, then I would have paid $601.50. Also, in the case of my Woolworths shares, I also paid $20 of brokerage costs to buy the shares initially 20 years ago, and another $10 in brokerage to sell them now. I would add these brokerage costs to my cost base. Also, as I participated in the Woolworths Dividend Reinvestment Plan, or DRP, for over 20 years, I acquired another 50 shares in this time at varying prices, which I totaled to have cost me another $1,005.21. This amount would also be added to my cost base. My total cost base would be $1,636.71. Now, there is an important thing to watch out with calculating the cost base, and that is not to rely on your online broker's cost base report. This is a trick for new investors. If you're using your broker's online report, then you need to remember that they will always ignore DRPs and other transactions like mergers and divestments. For example, if I use my broker's record of cost on my Woolworths shares, you can see here it only recognized the initial purchase price from 20 years ago of $601.50 and ignored the brokerage costs and DRP purchases, which is wrong and will lead to higher capital gains tax. Step 3. Subtract the purchase costs from what you received from the proceeds of the sale. If the result is more than zero, you have a capital gain for the sale of this asset. If it's less than zero, you have a capital loss for this asset. In my case with the Woolworths example, I have a gross capital gain of $2,003.29. If I just use my broker's account, my capital gain would have been much higher at $3,038.50, which means more capital gains tax, as my gain is higher than what it would have been if I had have included the cost of the DRP and the acquisitions from the DRP. Step 4. If you had sold other investments this year, then you would need to repeat steps 1 to 3 for each CGT event you have had this financial year. In my example, I'll assume I haven't, so I'll move on. Step 5. Subtract your capital losses from your capital gains. If you have no allowable capital losses, then there's nothing to subtract. If you have a net capital loss carried forward from previous years, you should subtract this now. Step 6. If the remaining amount is more than zero, then you have made a gross capital gain. Step 7. If you are an individual taxpayer and an Australian resident for tax purposes, and you have owned the asset you sold for more than 12 months, then you are eligible to apply the CGT discount of 50% to any remaining capital gains. In my example, I will select a capital gains discount of 50% as I am an individual and Australian resident for tax purposes. After applying the CGT discount of 50%, or the discount that applies to you, you have calculated the net capital gain. In the example, the net capital gain after applying the 50% capital gains discount is $1,001.65. A net capital gain needs to be reported in your income tax return costs you incur. Investors must report all gains and capital losses in their Australian income tax return and pay tax on their capital gains. Although it is referred to as a capital gains tax, it is part of your income tax. It is not actually a separate tax. So if you have a capital gain, it will increase the tax you need to pay after lodging your annual income tax return. However, if you have a capital loss, you can only reduce other capital gains and not other income like your salary or wages. Instead, capital losses that are unused against capital gains in one tax year can only be carried forward to future years to be offset against future capital gains. For individual taxpayers that sell shares at a profit, the capital gains tax rate depends on which individual marginal tax bracket that you fall into in the year you sold the asset when you add all your income together from all sources. For example, if you earned $44,990 from your day job and you make a $10,000 net capital gain from selling selling an investment, then your capital gain will be taxed mostly at the 32.5% marginal tax rate. This is because your total taxable income will be $54,999, which is $44,999 plus the $10,000 capital gain, which is above the $45,000 tax bracket, which applies in 2022, which attracts the 32.5% tax rate. If you have earned more income, then you could pay even more capital gains tax at a higher marginal tax rate. Importantly, unlike salary and wages, nobody's withholding tax from the amount that you receive from the sale of your assets, like your employer does on your salary and wage. So you are responsible for paying the tax to the ATO. This catches many people off guard, as many taxpayers don't keep money aside to pay the tax bill that comes after their tax return is lodged. It is best to work out how much tax you will owe when you sell and set aside funds from that sale to cover the extra tax bill when it falls due. When is capital gains tax payable? As capital gains are declared in your tax return, you will be issued a tax assessment within 21 days of lodging your tax return for the year that you sold the investment. When calculating capital gains tax for listed investments like shares, EFTs, and crypto, you can make your life a lot easier and automate the tracking of the cost base in real time and calculate an accurate return on investment using free online tools. I've been using a free online tool called ShareSite for the last 4 years. I use the free plan that allows me to track up to 10 investments at no charge. ShareSite tracks DRPs, mergers, demergers, splits, and all other types of transactions accurately and in real time. So I think it's a great tool. I'll include a link in the description of this video for ShareSite. Oh, and if you did choose to upgrade, then by using this link, you would also get a discount of 4 months free on your first 12 months. The video on the screen right now will show you an example of how I calculated capital gains tax on shares I owned for more than 20 years using ShareSite to do the hard work for me. See you in the next one.